Hello and welcome to the DIY Investing YouTube channel. We are doing 5-minute stock reviews. Today we're discussing AFLAC Incorporated, ticker AFL. This is my first 5 minutes of due diligence on this company, and I hope you'll follow along to learn more about my investing process and how I think about companies. So AFLAC, you've probably heard about it from their commercials, so that's where I'm a little bit aware of it. It's an insurance company. Let's look at their business description. They provide supplemental health and life insurance products. Operates through two segments, AFLAC Japan and AFLAC US. So we know it's in two separate companies. So Japan focuses on cancer, medical, and income support, gift, whole, and term life insurance. And AFLAC US segment starts with cancer, accident, short-term disability, critical care, hospital indemnity, dental, vision, long-term care, disability. So a bunch of different insurance products. Basically, the one that I know they advertise a bunch in the U.S. is these accident-based payouts. And so it's an insurance company, but it's not one of it's not like a standard life insurance company or a standard health insurance company. It's operating in more of this niche space. So they have a beta of 1, which basically means they have the same volatility as the index. I'd like to buy low beta companies, but again, it's pretty standard for large cap companies. Share turnover 123%, so you don't have a really strong shareholder base. A lot of index funds and such in here. So we come down in here into return on equity. I'm looking for stability, and I'm looking for a return on equity above 15% is what I'm looking for. So this looks to be a fairly stable company. There's not a single year in which the return on equity is negative. There's not a single year where the return on equity is less than 10%. It looks like the lowest is around 11%. But you have pretty good stability between 11% and 20%. And you spend a lot of time in that upper half. So you're in a good spot. This is meeting my threshold here of where I'd be comfortable investing in this company. Next, I want to go and think about median returns. So insurance companies have float and leverage. So you're going to see a dichotomy between return on assets and return on equity. This is pretty normal for an insurance company that you're going to see this gap here. What I really care about is this return on equity number. But again, I don't have a lot of experience analyzing insurance companies. So keep that in the back of your mind. But here I look at valuation ratios. I like that the PE is less than 10. That's a good metric to hit for me when I'm thinking about investing in a company. But the PE less than 10 seems to be for a reason. When I look at 10-year CAGR, revenue is fairly flat. 1% growth is basically flat revenue. It's not declining, but it's basically flat. You know, you begin the decade with 22 billion in revenue, and you end with 22 billion in revenue. But what really matters at an insurance company is kind of your earned premiums. So you have 20 billion in earned premiums, and you end at 18.6. So maybe it's a little lower than it was a decade ago. They don't seem to be growing. It seems like their market is saturated. So this is a mature company. You're not going to be buying on growth. You need to be buying on how they manage their assets, how they're investing, and that sort of thing. But so this return on equity then becomes less important. It doesn't matter if you're investing, if a return on equity is 5%, 10%, or 100% if there's no growth. High returns on equity only matter if you have growth. But this looks like a no growth company. So how is the earnings per share growing? And I'm going to guess that they are retiring shares. They're buying back shares. That's going to be my guess here. And we can go determine that by looking at the income statement. We can see shares outstanding. So yes, you begin with 939 million shares outstanding, and you end the period with 716. You can see slow and steady. They are buying back shares each and every year to retire their shares outstanding, and that's allowed them to triple their earnings per share despite the fact that they haven't had growing premiums. So again, the capital allocation here looks really good. Every year you're making money, and every year you're having dividends. Let me go see if there are dividends. I believe there are dividends. Yeah, cash. Every year you're having dividends, and every year you're having buybacks. So I love the capital allocation here. This seems to be a stable business, and it seems to be a reasonable price. So to me, this is an attractive company in the first 5 minutes. I'd want to do additional research. I need to learn more about insurance companies in general, but you can see this price to earnings ratio is pretty reasonable. Now, it's okay for P&E to be low. You want it to be low if you're not paying for earnings. Now, if this was truly a no-growth company, then I'd like to have a PE of like 8 to 10, but 9.7, you're in that ballpark. This is definitely worth some further look for me. And so I need to study, what is their underwriting process? How much leverage do they target? Capital allocation seems to be something I like. So I'm excited about AFLAC as a potential investment, and I think this one would go on my watch list. Thank you for listening, and until next time, stop paying fees, start building wealth. Like this video and hit that subscribe button for more great investing content.